Welcome, welcome, welcome to another episode of the How to Adult with Travis Walker podcast. Today we brought on a very special guest. He helped me with my second home loan. He has all the information. He is an incredible person in the Beaumont community. His name is Zach Stiles. He is part of the Roy West team. He does all types of mortgages, all types of things, and he brought all of the knowledge about home loans. You know, people think home loans are scary. People are scared of mortgages, but we really talked about it at a beginner and intermediate level today. We gained a lot of knowledge in terms of, are you getting ready to purchase a home with a home loan, or do you have a home loan and you want to do a little creative maneuver? Just a great episode. I'm really excited for you to learn more about it. With that being said, y'all, if you want to sponsor an episode, let me know, because I would love to support a business that supports my podcast. With all that being said, y'all, let's get into the show and learn how to adult. All right, we have made it to the next episode of the How to Adult podcast. Today, I brought on Zach Stiles. He is coming to educate us on all of the things in relation to home loans. I want to call this Home Loans for Dummies, maybe, because I really want to do the foundation of what's going on with home loans. But I'm really excited to have you.
Well, I'm super excited to be on the show, Travis. Thank you so much for having me. Home loans, oftentimes they are viewed as these big, scary things. And honestly, they're not really that scary as long as you're working with somebody that knows how to communicate and kind of walk folks through the process.
Absolutely. Absolutely. So before we get into the content of the show, I'd like to know just kind of what's your location, what you do for work. Give me some credibility on why should we trust you, Zach, with our home loans?
Well, that's a great question, Travis. My name is Zach Stiles. I'm with the Roy West team of Guild Mortgage, located right here in Beaumont, Texas. We have a brick and mortar location. We find that it's oftentimes easier to meet with folks face to face, talk about these types of things. I have been in the business for the last going on 6 years now. I made a career change back in 2016, and Roy's been in the business for almost 20 years doing home loans. He's probably seen just about everything you can see, and he still tutors me on a daily basis, mentors me, I guess is a better word.
Yeah.
So I learned from him, and we're just a local mortgage company here in Southeast Texas.
That's awesome. That's incredible. And the Roy West, y'all are part of a bigger conglomerate, right? With Guild. Can you explain that relationship?
Yeah, absolutely. So Guild Mortgage is like the fifth or the sixth largest mortgage bank in the United States. We just got the one of the best recognitions that you can get with the J.D. Powers Award in customer service. But the cool thing about Guild is they are a publicly traded company. They just went public a couple years ago, but they let all the branches kind of operate independently. So we have a real small town, kind of hometown feel within our branch and within Southeast Texas. But we have the backing of this huge company that gives us the ability to be super nimble in the marketplace, offer very competitive rates. And we have loan programs that a lot of other lenders don't have. And we can kind of dig into that a little bit more kind of as the show progresses.
Yeah, absolutely. Wow. Okay. So that is great. We definitely trust you now, Zach.
Good.
That's awesome. So I want to go super, simple. Just start at the basics. What are home loans and why do people use them?
Hey, okay, check it out. So home loans give people the ability to purchase a home, right? Because most people, don't have $150,000, $200,000, $250,000, $300,000 just sitting in the bank to where they can just go, boom, pay cash for a house. So what a home loan allows you to do is to essentially use somebody else's money for 30 years, and the mortgage company and the client have ownership in the home. And then the client's paying back over a 30-year, 15-year term, whatever they end up deciding, whatever works best for them, pays the mortgage company back until the end of the term, where they actually then own the home outright. So folks, you can think about it kind of like a credit card too. If you pay your credit card off every 30 days, you're just borrowing somebody else's money for that period. Same thing with a home loan. It's just with a home loan, obviously you're dealing with larger amounts of money, and there's a whole lot of guidelines and stipulations kind of in place to protect not only the lender, but also the client, so that they're not, doing anything that would be bad for them financially.
Right, right. That's a great, just simple definition of why these are being used. I'm interested, just a question that came out of my mind. Where does this money come from? So we're borrowing money from, let's say, the Roy West team. Where's that money coming from? Are there investors that just give y'all money, or is this money that comes from somewhere else?
Hey, yeah. So basically, you can think of it as a large pool of investors, okay,
Okay.
that are wanting to buy mortgage-backed securities. Okay, so you have this large pool of investors that are essentially, in layman's terms, putting up the money, and then Guild has access to that money to then lend to the clients. So on the back end, you've got all these investors that Guild is basically partnered with that are looking to then make money off of that loan for the next 30 years, which that's their benefit, is they're going to invest the money up front and then it's going to be paid back with the interest. And they're looking at a long-term investment. Mortgage-backed securities are based on the bond market. So if you know anything about stocks and bonds, as the stock market goes up, bond market is usually going down, and a vice versa kind of relationship. They have an inverse relationship. And mortgage-backed securities are traded on the bond market. They're viewed as safer investments, but they're also not going to be as volatile, right? So your earning potential may not be as high, but you're looking at that long-term investment.
Okay. That's just good knowledge for us to have, knowing where that money's coming from. I think that's really
Yeah.
good. I know this to be true, but what types of loans are there? I know there are multiple types of loans. Maybe we can walk through some of the most common ones that a lot of people see and would want to know about. What are the most common loans that we should know about?
So in the basic form, there's essentially 4 different loan programs. Okay. So you've got 3 government backed loans, and those are going to be your FHA, VA, and USDA loans. And then you have your conventional loans, which are Fannie Mae and Freddie Mac backed, right? So government loans essentially are just like it sounds. They're going to be backed by the government. So FHA, USDA, and VA are going to back those loans, whereas on the conventional, you've got Fannie Mae and Freddie Mac. So at the end of the day, right, lenders want to sell their loans to Fannie Mae, Freddie Mac, if you're looking at conventional, or make sure that FHA, VA, or USDA buys the government-backed ones. Hence why you have all of the guidelines and all of the parameters that we have to meet. And as you well know, having purchased a home, there are things that we have to check off: income,
Right.
W-2s, pay stubs, bank statements, those types of things. And the only reason why we're doing that is so that we can then turn around and sell the loan to FHA or whoever's going to end up purchasing it, because they have very high standards at what they are going to purchase and what they're not going to purchase. So the last thing you want to do is you don't want to originate a loan that all of a sudden you fund and then you can't turn around and sell it to that respective buyer.
Right.
So anyways, I digress a little bit. As far as most common loans, first-time home buyers, we oftentimes see FHA loans because they have a higher debt to income. Debt to income is essentially how much you have coming in versus how much you have going out. So there's a threshold in FHAs is at 55%. So basically your debt to income can be at 55%, which allows first-time home buyers oftentimes to have a wider buying power, a larger purchasing power. Because let's face it, I was a knucklehead. I've been a knucklehead. I've had bad credit problems. I've done all the things that you can basically do, to make getting a loan difficult.
Right.
So the FHA loan, it's backed by the federal government, but they're a lot more lenient on credit issues, debt to income, things like that. So we see lots of those here in Southeast Texas. Conventional loans, again, probably the second most common that you're going to see, maybe the first, but depending. But we do probably more government loans. Conventional loans are going to be a little bit higher standards. So debt to income, you can only go up to 50%. Credit score is going to have to be a little bit higher, things like that. But they also have some great first-time homebuyer options too, with like a 3% down first-time homebuyer conventional. It's just they want to see a little bit higher credit score, things like that. I'm not saying that you can't get qualified with a lower credit score on a conventional. It's just a little bit less common.
Right.
So those are the big 2, but we love helping veterans. That's the VA loans.
Right.
And then we love doing rural loans outside of Jefferson County. So if you're in Hardin County, Sour Lake, Orange, you can oftentimes get a USDA loan, which is a great loan program. That's a 0% down, just like the veterans is a 0% down.
Wow. Wow. So there's a bunch of different loans out there, and I knew of those. That's really good. And there's different programs for different types of people, and I think that's really fantastic. Would you say that there, and I'm sure the answer is it depends, but I'm going to ask it anyways. Is there, a better route that people should be striving for? I hear a lot of stigma of you should really try to go conventional. But I also hear other people say, FHA is really fine. You should do that too. So I'm interested in your your status in that debate specifically.
That's kind of the age old debate, right? Because again, it does depend.
Yeah.
But honestly, people should be trying to strive for the program that's going to work best for their situation and scenario. With that being said, if you have an 800 credit score and you're constantly trying to improve yourself and improve your credit score, a conventional loan option is really a great loan option and where you want to be if it makes sense for your situation, because really the biggest reason is mortgage insurance. Okay. The biggest difference between an FHA and a conventional is going to come down to the mortgage insurance. On a conventional deal, you have to pay mortgage insurance unless you put 20% down. So we offer conventional loan programs at 3% down, 5% down, whatever, all the way up to 80% down, but you will have private mortgage insurance that you're going to pay. With that being said, if you have a lower credit score, okay, it's going to be a little bit more difficult to get qualified for a conventional loan, and the mortgage insurance is going to be sky high, right? So to answer your question, if your credit score is solid and you have a low debt to income, then a conventional option is going to be great, and you're not going to have to worry about the mortgage insurance for the life of the loan like you would on an FHA option. Okay. Sure. And that's really the biggest difference. Now, one thing that a lot of people don't know, and I bet there's a lot of people that listen to your podcast that don't know this, two things. You don't have to put 20% down to buy a house. Okay.
Hey,
people think that.
Gosh. Go off.
I know. It's crazy, but you don't have to put 20% down. Like I said, we have 3% down, 3.5% down options. But secondly, people don't know that on an FHA loan, if you put 10% down, you only have to pay mortgage insurance for 11 years.
Oh, wow. I didn't know that.
Yeah, most people think that an FHA loan, no matter what, I mean, there's agents that don't necessarily know that. And it's just not something that's talked about very much. But yeah, I do FHA loans. People, maybe their credit score is not where they want it to be. And I'm like, hey, look, but they've got money. Hey, put 10% down. You're only going to pay mortgage insurance for 11 years, which honestly, if you put 3% down on a conventional loan, you're probably going to pay it for 11 years anyways. Right. So why not at least get you qualified versus not being able to get you qualified? Because oftentimes, Travis, that's what it comes down to. Maybe a conventional loan would be great in a perfect world, but do you want to buy a house? Do you not want to buy a house? And how quickly, what does that timeline look like? And if you can only get qualified going FHA, but by golly, they're going to go FHA.
Right. That's what it comes down to. And I just want to break down a few terms just really quick. I want to talk about what an interest rate is. But first, talking about mortgage insurance, since we're right there on that topic. What is mortgage insurance? What's the purpose of it? Why does it exist? Can we dive into that for a second?
Yeah, for sure. So mortgage insurance does one thing and one thing only. It benefits the lender, right? So it was put in place that in case, say, Joe Blow decides that he's going to default on his mortgage. Well, the lender has that mortgage insurance in place that the buyer, Joe, has been paying. So then that mortgage insurance company will then make the lender, quote unquote, whole, right? So then the lender is not being left holding the bag, for that entire note, entire house, entire, amount of whatever that purchase price was. If it was a $300,000 house, they're not left holding the bag for $300,000. So right. It's required on all loans except conventional, and only if you put 20% down on conventional. Now, the biggest difference is FHA and government loans, VA and USDA, there is no mortgage insurance for a VA loan. That's a little bit of a lie. You kind of just pay it up front. But my point is it's backed by the government. They actually handle the mortgage insurance. Whereas on the conventional side of the world, you have mortgage insurance companies that there's about 5 of them in the United States. And they're just like car insurance companies. They're going to quote you and they're going to quote the deal. And any lender is just going to go with the cheapest one.
Right.
But it protects the lender is what it does.
That makes sense. It's going to be a line item for some people. And I want people to understand what that is because it's really important. We had on our first home we had mortgage insurance, and then our second home we don't have it. So people need to understand kind of what that is.
Right.
Transitioning for a moment, I want to talk about what an interest rate is. You know, some people are familiar with this because they buy cars, or they have credit cards. But I'd like to talk about what an interest rate is and why do I care what that number is specifically with a home?
Yeah. So interest rate is essentially the cost of the money, right? So that's exactly what it is. How much is that investor going to be making on top of, the money that they're lending you, right? So why do you care what it is? Well, because obviously over a 30-year period, that interest rate, while it may not be much monthly, over a 30-year period, it can end up being $30,000, $40,000, $50,000 of interest that you're going to be paying on said loan. Okay. And interest rates, and this kind of ties directly back into the stock market and mortgage-backed securities. And we can even talk about it a little bit if you want about why they're going up right now and kind of what's going on in the markets. But
Please.
Essentially, as the stock market is doing well, the bond market is normally not doing as well. So there's more people putting their money in the stock market and vice versa. So if the stock market's going down, typically the mortgage-backed securities, the bond market is going to be going up. So more people will put their money in the bond market or mortgage-backed securities, which is viewed as a safer but not as lucrative market. So what you had going on, so it's an inverse relationship. So if stock market's doing really well, normally interest rates are going to be going up. If stock market's doing really bad, normally interest rates are going to be going down. Okay. But let's take just a look at COVID and what happened in 2020 and 2021.
Sure.
2020, all of a sudden, one of the easiest ways that the Fed was able to bolster the United States economy was to basically lower interest rates across the board. Okay. So what they did, though, they don't like the Fed. The Fed does control interest rates to a degree. A lot of people confuse the Fed rate with the housing interest rates.
Sure.
All the Fed rate is what the cost of money is between banks lending to other banks. Okay. So let's just get that out there in the open. The Fed does not directly control rates and say, hey, they're going to be 5% or whatever they're going to be. Yeah. They will control the rate of what banks are lending to other banks and what that rate looks like. One way that they can directly manipulate the market, which is what they did in 2020, is they actually started buying millions of dollars every single day of mortgage-backed securities. Mortgage-backed securities changed and are traded just like stocks, okay? But now all of a sudden you had the Fed come in and they said, we're going to spend millions of dollars each and every day buying up mortgage-backed securities. So what did that do? That automatically triggered rates to just plummet. Okay. So now all of a sudden rates are just in the 2s, in the 3s, like we saw for all of 2020 and 2021. Well, what are they doing now? Well, now what they decided to do is they're easing the rate at which they're buying those mortgage-backed securities. So now instead of the Fed being the biggest buyer of mortgage-backed securities, they're saying, look, we're not going to spend millions of dollars each and every day. Maybe we spend $1 million a day, but we're not going to spend $10 million a day. So what does that do? That all of a sudden, now the market is again deciding what mortgage-backed securities are worth. Therefore, the market is now determining where the interest rate should be, which, look, 2020 was great. 2021 was great. We did lots of refinances. I think everybody in the world, United States anyways, refied probably within that period of time. And it was great for lenders. It was fantastic. It was just going nuts. But honestly and truly, if you're a believer in the free market and how the market should operate, truth be told, I feel that the government shouldn't necessarily be controlling what the interest rate should be. So now what we're seeing is what the market says rates should be. And honestly, market says rates should be around 5.5%, right now. And I anticipate that rates are going to come down whenever we hit a recession. But until then, I think we're going to see around 5.5 probably through the rest of this year. Unless something just crazy happens. And then we're going to hit a recession. And then I think we're going to see rates dip a little bit. And then we're going to do a bunch of refinances for everybody that's kind of buying houses right now.
Yeah, I mean, everything that I consume a lot of personal finance, which also comes with a lot of real estate content as well. And, everything that I hear and everything that I read says that the market in itself, it fluctuates, obviously, but there's also, um, it's like a redirecting door, like a revolving door. It changes over and over again. And if you're in the game long enough, you really see those different areas come and go. Have you seen that as well, or am I making things up?
No, it's very cyclical, right? So you're going to see, I've seen rates in the fives before. I mean, in 2016, they were in the threes, and 17, they started inching up. And then in 18, they started hitting the mid fours, almost getting to fives, a little bit of fives here and there. And then we saw them come down. I mean, and it all depends on what's going on in the world, right? I mean, it's easy to look at the stock market and the bond market and things like that, but other things that don't get taken into consideration were COVID. Nobody could have seen that coming. Nobody would have ever dreamed that rates would be in 2%. And we may never see it again in our lifetime.
Sure.
But I mean, like other things, inflation, unemployment, all those types of things go into what rates are and what the rates are doing. Again, they trade every single minute of every single day. So
Right.
it is very cyclical. Right now, the sky is falling, according to some people, but really, I mean, look at rates in the 80s. No, look, they were at, 8, 9%. 10 or
Right.
11%. They got up there, or I'm in the 70s. I'm sorry. In the 80s, they got like to 18%. My parents bought their first house in the 80s, and it was like 18%.
Oh
You
my
know,
gosh.
I mean, so it is cyclical, and rates are still historically low. And that want to buy a house are still going to buy a house. And I encourage people to buy a house, especially if you're renting or things like that. I mean, it's still a great time to buy. The market's hot, and real estate's still a great investment.
Yeah, I was going to go somewhere else, but since you brought this up, I'd love to kind of dip into the debate of rent versus buying, because I think somebody listening to this podcast is probably renting, or if they're here to learn something, they're probably renting, and they may be trying to transition to home ownership. What is the debate here? Can you kind of dive into that for a moment?
Yeah, 100%. So I did these numbers just the other day for a client because they were having the same kind of going back and forth. And I said, well, what's your rent? They said $1,500 a month. So great. So that's $18,000 a year. Okay.
Yeah.
That you're using to pay somebody else's mortgage and or apartment or whatever all that looks like. I said, you double that, you're at $36,000 that you just thrown away. And I know that renting and things like that, it serves its purpose. I rented for a long time when I first got out of college. Like, I get it. But at
Right.
the end of the day, if I could do my life all over again, I would have purchased a lot sooner. And it's really cool when I see young guys like in their 19 and 20, and they're buying houses, and they're saying, look, yeah, I'm not buying my forever home right now, but I'm buying a home that I can live in. And then all of a sudden I can live in it. I can have a roommate. Now my roommate's actually paying my mortgage. So my point to all of this is I encourage people, the sooner you can buy, the better. And even if you're not planning on being in Beaumont or wherever you're living forever, it still doesn't hurt to have a couple of rental properties here and there if that's what you want to do. But even so, say you're only there for a year, you're still $18,000 that you're building in equity versus all of a sudden you're not building that equity. So when you go
Right.
to sell, and with home prices the way they're going right now, and it doesn't appear that that's going to slow down, prices are going to continue to go up. And now you just have an asset that's gaining value. So when you do go to sell, maybe if you don't make $18,000 equity, fine, but it also look at what you saved and what you didn't lose, right?
Right.
So even if you're not going to break even, but even if you did break even, you're still in a better position than if you had just been paying rent forever and ever.
Oh yeah,
So
and I think there's also something to be said for the experience in terms of going through the home buying process, going through the home ownership process as well. You learn so much in that process. Doing it twice, I learned different things doing it the first time than doing it the second time. And then being a homeowner is just a whole different world because you actually have to take care of things. So I think I agree with everything that you said, but I think there's also back burner reasons in terms of just being a human that is kind of more well-rounded. I would say maybe that's offensive, but
Yeah.
I'm going to go with it.
Well, and the other side of it is I think one of the things is people just think that they can't buy a house.
I think that for sure.
Yeah. People just assume like, there's no way. Like, I know what I did. I know I did something stupid on a credit card, or I did whatever. And I just said, my response to that is like, yeah, but you don't really know. Like, you're not a lender. You know, you can Google things all day long, but you don't know really what it takes to buy a house. And we really only look at a couple of things. What's your debt to income? Again, how much you have going out versus how much you have coming in each month. We look at your credit score. And right now we can do deals for people with a credit score as long as it's better than a 540. So,
right.
It takes a lot to get below a 540. So I always tell people, like, if you don't think you're qualified and you're just going to not do anything, well, then you're dang sure not ever going to buy a house. But even if you don't think you're qualified, why not just see? I mean, you're going to take a hard pull on your credit, but at the same time, you're not doing anything to move the needle. If you're just sitting there, it's all in your mind, and you're just, and in human nature, you just assume the worst. But I've had lots of clients go, dang, I didn't know I could buy a house. That's awesome. And then they buy a house and they're super excited about it. And that's one of the reasons why I love doing what I do, is getting to put people in homes. And especially the fun ones are the ones that are like, man, I never thought I could do that. And then you're at the closing table and everybody's high-fiving,
Yeah. Yeah, I mean, it's definitely changing people's lives. And you've hinted at this a couple of times. You've thrown out a few terms. And so I'd like to talk about for a moment how we decide how much specific people can be loaned. So we talked about debt to income. I think that's pretty straightforward. But there's other factors like credit scores. I'd like to maybe talk about what are the biggest things that hurt people and their credit scores that kind of keep them from maybe a home purchase. So I'd like to kind of talk about how do you decide how much I get?
Well, it's like you said, there's several different factors that come into it. Credit score being a big one. Debt to income, loan to value, which is also how much money you're going to put down. Obviously, the more you put down, a client puts down, that can be favorable, for the amount that we're going to lend, things like that. You hit on credit scores and things that people need to watch out for. So I'm glad you brought that up, because credit scores, the credit systems, the credit bureaus, first of all, I think it's a little bit of a broken system and it needs to be redone. But taking my personal feelings out of it, there's some big things that you can do to ensure that your credit score is going to be favorable, right? One of the things is, if you have $1,000 credit card, don't spend $900 on that.
Don't do that.
Don't do that. Okay. Spend maybe $300 or less. You want to try to keep your credit utilization below 30% across the board, right? So if you have $1,000 limit, don't max it out. If you have 7 credit cards and they're all maxed out, your credit score is not going to be good. But if you have 7 credit cards, which is fine, and you have $300 on each card, that's a heck of a lot better. And pay it off each month. Try and pay it off each month. Even if you can't pay it off each month, try not to have huge rolling balances on your credit card debt. That's a huge thing that affects credit cards. Another simple trick is, if you are having credit issues, or if you have good credit and you just want a better credit, like one thing that I do is I with Capital One, that's who my credit card's through. I call them like once a month and I ask them to go up on my limit. Not because I'm going to spend any more money, but because, hey, I just want that more. I want a larger available credit line.
Right.
Because the larger credit, the amount of credit that you have, and the less you use, the higher credit score is going to be. It's pretty simple in that regard. The other things are, don't get a car repoed. I mean, that's never going to be good.
No.
People, medical collections, people know because of the Google machine that we don't take medical collections into account. Yeah, you're right. We don't. But guess what? The credit bureaus still take medical collections into account. And guess what? They're still going to lower your credit score if you have 17 medical collections. So while we don't count them when debt to income and things like that, it's still damaging your credit score.
Right.
One thing that people will try and do to try and subvert the system is they'll dispute accounts. Because again, if you look in the Google machine, you can dispute credit lines, and it takes those credit lines out of the scoring algorithm that lenders use. The problem is, like, we see that, and oftentimes, almost 99% of the time, we have to have those disputes removed. But what do you think happens when you have those disputes removed on those bad accounts? Your credit score is going to tank.
Right.
So don't dispute accounts. Try and, and another thing is, and I'll tell you this, Travis, a lender is going to find out everything. So just be honest with us up front, please. Like, I'm begging you, just be upfront with us, because a good lender, I mean, these big box lenders, yeah, they may not find out till you're halfway through the transaction. But then you're halfway through a transaction, you've spent money on an inspection and maybe an appraisal, and your deal doesn't work out.
Right.
But a lender worth his salt, just be honest with them and we try to get all the information up front so we can try and see if there's going to be any pitfalls along the way. Because the last thing I don't want to do is pre-approve somebody and them not get to the finish line. I mean, that's what I lose sleep about. Is there something hanging out there that maybe they didn't tell us? Don't quit your job, things like that. Anyways, I know I digress off of the credit score thing, but we do look at job history, and in our area, we have guys working oil and gas, and they switch jobs and operators and things like that. They may work for 10 companies in 2 years, and that's okay. We're able to work with that. Some lenders may not be able to, but we can do that all day at the Roy West team. But just be honest with us on those job gaps, because we can normally get through that. But don't have a job gap that I forgot to tell you about that, because then that all of a sudden kind of puts more steps in the process that we kind of have to backtrack on. So I would say be upfront and honest too on residential history, work history, how you're paid, whether it's 1099, W-2, things like that. Self-employment too, that's a big one. Anyways, I know we could talk about all those things forever and ever, and it's super boring, but biggest thing is just paying attention and being upfront with your lender.
Yeah, absolutely. I know when I was working with you guys, both my wife and I were going through a job transition. And it added a step. Y'all needed like a confirmation of employment, but it made it so much faster that we were able to tell you all that and get it done. And so I definitely agree. So there's a bunch of different things that you need when you buy a house, like a lot of paperwork, and it's a lot of scary stuff, right? You have to have all of your life's documents in order. What are the things that people are missing all of the time? What do people need to keep up with if they are thinking about buying a house in the next 80 years?
Okay. I mean, we've actually cut down a lot of the things that we need. And in this new digital age, we can get a lot of things via some online services and things like that. But we're Southeast Texas, right? So not all of the employers are automated yet. So there's some definite things that we need to make sure you have. Here's one thing. Everybody says that they don't get pay stubs. I promise you, you get a pay stub. Okay. They exist. Now they may be online, but because I get it all the time. It's like, well, I don't get pay stubs. I'm like, I hear you. I get it. Like, it's direct deposited into your bank, but there is a pay stub for you somewhere, because the company you work for is not just direct depositing money into your account willy-nilly. Like, they are keeping track of your hours or salary somewhere. So it's nice to know where your pay stubs actually are. So I would encourage listeners, just have an idea. If they use like a big ADP or whoever it is, just have an idea how to access your pay stubs. Generally speaking, we are going to need to see pay stubs and things like that. The other thing that I would mention is keep track of your W-2s, especially you operators and you guys out there in the oil and gas industry. We get that y'all work a lot of turnarounds and things like that, but it's super helpful if you have the W-2s for those. So just have a file or a cabinet or somewhere in your home, a safe where you keep your W-2s every year. And then maybe every 5 years, you can kind of cull them and just keep the most recent 2 years. But I would just make good practice of holding on to those W-2s. And again, know where your pay stubs are. And then the other last thing, I guess, is bank statements. I do get quite often that well, I don't get bank statements. I'm like, well, good. I love you. And I love the fact that you're being nice to our environment and that you've selected paperless, because most banks now, they offer paperless. Right. But I promise you, somewhere there is a bank statement showing what you've done in the month, how much you've had coming in and how much you've had going out. So just be familiar. If you're going to go to a lender, it's nice to be able to go, yeah, I actually know how to access really pay stubs, bank statements, and W-2s. Yeah. Those are kind of the big ones. You can get off in the weeds on investment accounts and things like that. But the big ones are those. And I guess really, if you own other properties, it's really nice if you can provide the addresses for those other properties is nice. And the taxes and you're putting your hands on the insurance for those other properties can be helpful.
Sure. I know both times I went through the home loan process, tracking down my dang W-2s were like warfare. I don't know. I was young both times. I'm still young, I guess. But so keeping up with this stuff is crazy. But Yeah, keep up with your documents. That's so important.
It really is.
You got to plug your mortgage company at the beginning, and so I kind of want to talk about mortgage companies just in general. Are they all built the same, or should people shop rates? Should people shop mortgage? I've heard people say that they shop interest rates, they shop mortgage companies. Should they do that, or is it not worth it? What do you think?
You know, I mean, obviously, since we're the Roy West team with Guild Mortgage, we're the best local mortgage company in the world. Anyways, but
obviously.
Look, you know, you're going to find your right fit with whatever lender. Okay. A lot of times I tell people, like, shop the loan officer. You don't necessarily need to shop the rate and the fees because they're going to be so close. Right. And oftentimes, if you hear something that's too good to be true, it's going to be too good to be true. Most mortgage companies are going to be within 1/8 of a point of each other, 1/4 of a point of each other. Very rarely do I see something come in and you get beat by like a whole point. Like that we don't live in a world where that necessarily happens because usually somebody screwed something up, truth be told, you know? And so that's why I say, you know, be comfortable with the loan officer, be comfortable with how quickly you can get them on the phone, be comfortable with their process and things like that, and ask about their process. Ask them, you know, what are your hours? Do you work evenings? Are you going to be available on the weekends? Things like that. And if it's not important to you, then great. It's not important to you. But if it is something that matters to you, you kind of want to know that going into it. Right. I mean, because truth be told, oftentimes things do happen after hours and on the weekends, and you do want to have access. And what I will tell everybody listening, get a loan estimate, get a quote, get a legitimate estimate from the other lender, and make sure you understand what everything is, because there's so many things that lenders don't control. We don't control the price of the appraisal. We don't control the title work. We don't control the price of the survey. There's like literally 2 things that the lender can control: their fees, which are going to be standardized normally across the board.
Right.
And that's covering like your underwriting and processing and things like that, keeping the lights on. And then like buying down rate. You know, I mean, we give everybody an option. Do you want to buy down rate? Do you not want to buy down rate? It doesn't matter to us. Literally, it does not matter to me. And I have clients that want to buy down rate furthermore than like maybe what we even initially show. But 9 times out of 10, you know, you buying down 1 point usually makes sense because you're going to make money within 2 years of spending that money, you know, to buy down the rate. But beyond that, like, unless you're just cash heavy and you just want to, and you feel like you're going to be in the house forever, it may not make a lot of sense to buy down rate a lot. And I know that we haven't really covered that term and terminology, but my overarching point is just understand what the lender actually controls versus, you know, what they can't control. Because I mean, I've seen Quicken Loans and I can beat up on them all day, but they'll say that an appraisal is going to cost $300. Wrong. It's not going to cost $300. There's not an appraiser in Southeast Texas going to do an appraisal for $300.
Right.
Quicken Loans thinks there is, you know? So that's my point, you know?
Yeah. And so maybe you threw out kind of a big name. Maybe this is also a good time to, you know, talk about websites like Zillow and realestate.com and the numbers that they throw out as, you know, mortgage estimates. How do you feel about that? You know, are they a good snapshot? Are they a terrible snapshot? What do you think on that? Because people do it. People go,
yeah.
Look.
I mean, my thought is it's garbage in, garbage out, or it can't be. I mean, they don't really know what the taxes are. They may, but 9 times out of 10, it's just a number that they've pulled. Oftentimes they can be wrong even on local listings because maybe the current owners have an over 65 and a freezed, you know, tax rate, you know, things like that. So I just tell people be very cautious. You really want to talk to a local lender. And I say local, when I say local, I mean it in every sense of the word. You want somebody from Southeast Texas, because guess what? If you have a lender in Dallas and they're quoting you an estimate down here in Southeast Texas, they don't know that you have to have windstorm.
Big deal.
And that's a big deal. Oftentimes your windstorm insurance is going to be more than your hazard insurance. Actually, every time it's going to be more.
I know
in Southeast Texas. So you have these lenders from other areas. They don't know that. So then all of a sudden you think you're getting some sweet deal and your monthly payment's going to be $1,000 a month, but they didn't factor in windstorm or flood, you know? And I don't know if you've seen what flood insurance rates are doing right now, but no longer are the days of a $500 a year, you know, flood insurance policy. I mean, they've gone to this new flood 2.0, And now flood insurance is normally going to be around $1,000, and that's in a non-risk, flood zone. If you are in a risk area or higher risk area, I mean, you can be looking at $2,000-$3,000 a year in flood insurance. So all that to say, the big box guys don't know what appraisals cost, surveys cost. They don't know what insurance is, and they're probably not going to know what the taxes are. So if you want to know what the principal and interest might be, maybe start there. But beyond that, you really need to get an insurance quote, go to JCAD, go to Hardin County, get on the appraisal district, find out what the taxes are. You can do it yourself with just a couple of website searches.
Yeah, there you go. So let's dive into like a really big term and sort of a debate between different people. I think the older generation has a feeling and the younger generation has a different feeling. But I want to talk about what escrow is and what it does, the benefits, why people feel a certain way about it. What is escrow and what's its role?
So escrow account, I tell people it's a bank account that the mortgage company is going to manage for you. Okay. So at Guild Mortgage, we service like 99% of our loans. And I just want to, let me take a little dive off into that real quick. So
That's
not
fine.
all mortgage companies service their own loans. Okay. So there's a lot of people in their minds that are listening right now, and they're like, I don't even know what that means, or what does that mean? Or I know my mortgage got sold before I even made my first payment and blah, 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 blah. That's true. Most lenders don't have a servicing arm. However, Guild Mortgage, we have a servicing arm. So while we are trying to sell the loan to Fannie Mae, Freddie Mac, FHA, VA, USDA, that's where we're selling the loan to, we retain the servicing. So Travis, you make your payment to guildmortgage.com, right? And that's where you're going to make your payment, to guildmortgage.com. So Guild Mortgage manages lots of escrow accounts is where I'm going with this.
Sure.
Because like if you have a question on your escrow analysis, which you're going to get an escrow analysis once a year, essentially, it's a bank statement that shows the money that went into your escrow account and the money that left your escrow account. And you're going to get one of those once a year. And they analyze those and they figure out, hey, do we have enough money that we're collecting each month for the taxes and insurance? Okay. Mm-hmm. So I've gotten a little ahead of myself, but an escrow account, like I said, is a bank account that funds go into to pay your taxes and insurance each year. So with your monthly note, like I'm looking at a servicing deal right in front of me right now. You've got your principal and interest, and you've got your taxes. If your taxes are $3,000 a year, whatever that looks like, just divide that by 12, and that's how much monthly you're going to put into that escrow account. Same thing for insurance. If you have a $2,000 a year insurance policy, then 1/12 of that is going to go into that escrow account each and every month. So that money is constantly building in that escrow account. And then what happens is the insurance company sends Guild Mortgage a note that says, hey, Travis's insurance is due on December 1st. We need you to pay that. Great. Guild Mortgage cuts a check on Travis's behalf and pays that. Travis is none the wiser. He just keeps paying money into his escrow account. And that's how it works each and every year. Same thing with taxes. Now, here's the sticky part. And here's where people get frustrated, confused, out of sorts. Your taxes and your insurance, folks, are going to go up every single year. I'm just telling you, they don't go down. Like your insurance company is going to go up. It's not going to be much on insurance, maybe $20-$30 a year on insurance. But like taxes, I mean, I had people in Jefferson County, they don't go up on the tax rate in Jefferson County. They go up on the appraised value. Okay. Last year I had clients whose houses were $150,000 on the appraisal district. Great at whatever the tax rate is. Well, then this year, now they're $250,000. Like literally Jefferson County went up on appraised values by almost $100,000 almost on everybody's property last year. So everybody's taxes went way high. So I got lots and lots of calls on these escrow analysis because they're like, man, why is my house not going up? Why is my house going up? I thought my interest rate was fixed. And it's like, whoa, hold your horses. Your interest rate is fixed. Your principal is fixed. Your principal and interest is never going to change for 30 years unless you refinance. Okay. Not going to happen. But taxes and insurance are going to go up. And if you escrow, which you're required to escrow on all loans except conventional, unless you put 20% down, your monthly note's going to go up every single year based on the mortgage company having to constantly increase because of taxes and insurance. So what happens is if your taxes go up by $1,000 in a year, well, there's $1,000 shortage that Guild Mortgage wrote a check for, and they need to collect enough to repay back the shortage and to set up your account. So now they know that $1,000 needs to be divided out over 12 months. So I know that's very lengthy, but the point of it is your escrow account is a bank account that you're putting money into that goes to pay bills each year. And if those bills go up, then your monthly note's going to go up.
Sure. And I guess some people believe that doesn't occur if you self-manage your taxes. I've heard that. And so I just kind of want to throw that out there. It sounds like it has no effect if you self-manage or if you use an escrow.
Yeah, and I've done it both ways personally, to where I've managed my own and had escrow. It ends up coming 6 one way, half a dozen another. The nice thing about if you don't escrow is you just get the tax bill and you're just like, okay, I owe $3,000 in taxes. Great. You write a check and boom, it's done. You're not seeing that yearly incremental increase, and you're not seeing. So some people, they just don't want to see their monthly note go up. So
Fair enough.
So they'll just be like, look, I'm just going to pay the mortgage company my principal and interest, and I'll self-manage. But in all actuality, it doesn't matter. It's all coming from the same spot, right? It's all the same money. You're just paying it once a year and writing a check for it.
Sure.
So,
sure. That totally makes sense. And so I think that's maybe not as much as a debate as I thought. So I want to know your thoughts on, what do you think the biggest misconception is about home loans?
Oh gosh, that's a good one, Travis. I think one of the biggest misconceptions, well, there's several misconceptions. One of the biggest ones is that first and foremost, people think that the mortgage company is making interest on escrow accounts and things like that. That's not the case. Mortgage companies don't make interest on the money that you have in those escrow accounts. So I would like to, just squash that. Secondly, one of the biggest ones, and we've already talked about it, but I'm telling you, I address this all the time. People call me all the time and think they got to put 20% down to buy a house.
Fair.
I mean, it's just not the case, And another thing is, a lot of times that people think that an FHA loan is a bad loan. It's not a bad loan. It's a great loan. We do lots and lots of them. It gets people into houses. Can a conventional loan potentially be a better loan? Yeah, absolutely. At some point in that person's life. But if you're just trying to buy your first home and you've got new credit and things like that all day long, why not use FHA? You can always refinance into a conventional loan at any point down the line. So, I think that's another misconception, is people think oh man, I'm locked into this deal for 30 years. No, you're not. You can refinance it whenever you want, or you can sell it whenever you want, or you can pay it off whenever you want. There are no prepayment penalties. People think that they're going to take a penalty for paying off their loan. There's no such thing as that anymore. They did away with that in 2007 and 2008. You can literally buy a home with us tomorrow and then pay it off the very next day. Say you win the lottery. I mean, so there are no prepayment penalties. The mortgage company is not going to hit you with a fee if you pay it off. I would like to talk about one thing if we have time.
Go ahead.
It's called recasting. Yeah, it's called recasting. So I get this all the time. People want to buy a house, but they have a house that they need to sell, but they can afford to float 2 house notes for a little while. So they don't want to have to sell their house in order to buy a house, right? But they're going to make maybe $100,000 off of their sale whenever they sell it. But maybe they don't have $100,000 to put on the new house. Okay. So what they'll do is they'll do a conventional loan, put 5% down on a conventional loan, buy the second house, and then get their current house, ready to put on the market. And then they'll sell their house 6 months later after they've had time to foo-foo it up and make it look all nice. And then they'll call me. But a lot of people are like, but that 100,000 that I just made, I want to be able to put that on my note. I want to be able to do something with that.
Yeah.
And they're like, because some people will be like, well, I don't want to buy until I do sell because I want to put this huge amount down. And if I don't do that and I only put 5% down, then I'm going to be stuck with this higher monthly note because I didn't put $100,000 down. Right. So we have a solution for that on a conventional loan. It's a conventional loan product only. And it's super easy because we do service all our loans. It's called recasting. So we do this all the time with clients. They'll put 5% down. They'll sell their house and they'll call me and they'll be like, hey, Zach, I just sold my house. So I want to put $100,000 towards my note. I'll be like, sweet, we can make that happen. Perfect. Literally, I call my servicing department. I get the instructions. I send them the instructions. They send a cashier's check into Guild Mortgage. And within like 60 days, we've recast the loan. And what that means is we lower their monthly payments based on that huge principal reduction. Doesn't cost anything to do. It's awesome. And people don't even know about it. And so like the reason I want to bring it up is like, if you're in that boat and you're like, man, I want to put a lot down, but I have to sell first. Like you really don't, because 6 months later we can do it. And it's as if you put that 100,000. I mean, you can get out of mortgage insurance, you can get out of escrow, all in the same deal. You're not stuck with your escrow account. You know, You're not stuck with the PMI on a conventional loan product, because at 20%, you can request that the PMI be removed. At 78% loan to value, it gets dropped off no matter what.
Right.
So anyways, I just wanted to throw that out there, because that is a misconception. People are like, oh, I can't ever do anything with this money. It's like, no, you can put it directly toward the principal and we can make it happen. Now, not all lenders can do that or have the ability to do that, but we do have that ability.
Yeah, because y'all are special, obviously.
Yeah, that's right. Yeah, and amazing and awesome and all the things. So.
Exactly. I want, as we're running out of time, I want to, and maybe this is a loaded question, and if it takes time, that's fine. I just kind of want to get your gauge on the status of mortgages, home loans in the United States. Is it a good time? Is it a bad time? What is that final note on just the status of the market in general?
Look, in the 2010s era, interest rates were like on average around 6 and 7%. Okay. Right now they're around 5.5%. So people were buying homes back then. People are going to continue to buy homes now. It's still a great time to buy and to be in real estate, because prices of homes and the values of homes, we're not seeing a slowdown on that. Everything is tracking towards home values are going to continue to go up at least till 2026 right now, is I think what I've seen. So, I mean, the longer you wait, right now, especially because I think rates they're going to bounce around this 5.5 kind of mark. But I mean, I think that they could go up a little bit towards the end of the year until we hit that recession, which most people are assuming that we're going to hit, just with everything else going on in the world with inflation and things like that. But just think about it like this. There is a cost in waiting, right? So I've had literally clients that whenever we saw them go above 5%, they like backed out of deals. And now, guess what? I'm getting contracts this week for those same clients, and now their rates are a quarter of a point higher. So there's that cost of waiting, right?
Oh, no.
Yeah. So now they're like, well, I guess I shouldn't have canceled that other transaction that I was in on that house that I liked even more than this one, because I got a little bit scared on rate. Like on the whole, these rates are still historically low, and they're not going to impede anybody from actually buying a home. A lot of it's just the mental angst and all the news and the media and the nonsense that you see. Right. Real estate's a great investment. You're still seeing the values go up. You're still more than likely going to make money when you do go to sell, just with the way that the values are going. I still think it's a great time to buy. Obviously, don't refinance. You're not going to be refinancing anytime soon if you buy.
No.
But hey, if you want to do that home improvement loan, it's a great time to do a cash out refinance, because rates are still going to be lower than what we can get a construction loan for. So I anticipate we're going to do some cash outs. I anticipate people are going to do some cash outs to do other investment properties and things like that right now. Overall, it's a lot to do with negative media, and that's causing people to be in this frenzy. But talking to people and dealing with people that have been through it, they're like, man, I should have just done that house a month ago at the lower rate in the house that I really liked. So there is that cost of waiting. So I would say, look, if you're looking to buy a house and looking to move, don't let the interest rate keep you from doing that, because historically the cost of waiting is going to be a lot higher than what interest rates are right now.
That is a fantastic way to end, I think. Such great knowledge and some really good, I think we had a really good mix. I kind of came into it thinking we were going to be really in the beginner type of content, but we really kind of went into the intermediate a little bit. I would say I bought a home twice, so let me have this.
Right. Yeah.
So I really appreciate you, Zach. And so where can people go find information about you, Guild Mortgage, Roy Westing? Where should people go find information about you?
Yeah, so you can check us out on roywestteam.com. I mean, you can fill out an online application there. You can reach us at our office at 409-866-1901. You can always reach me on my cell phone at 409-273-9744. Hit me up on Facebook, Messenger, Instagram, any of those types of outlets. I'm on TikTok. I mean, you can find me pretty much anywhere. And I'm always happy to help. We have an office right here in Southeast Texas, right behind Olive Garden, right on the west end of Beaumont. We service all of Texas. I'm happy to do loans anywhere in Texas. I also have a branch in Louisiana. We can help you out over there too, and we'd love to help you again. RoyWestTeam.com is probably the best place to go. Hit me up on my cell phone too.
There you go. There you go. Well, go find all that information. I can't repeat it because there was so much. So go find all that information. Also, go follow the podcast at How to Adult TW on Facebook and Instagram. If you are interested in sponsoring an episode or sponsoring this season, reach out. Let's work something out. I love supporting businesses that support my podcast. As always, y'all, we are going to continue to learn how to adult together.